Hello everyone, welcome to another episode of Financial Tidbits here with me, Royston at NAOF. Once again, stock market valuations are at sky-high levels, and this isn't because world economies are booming. Yes, compared to a year ago where corporate earnings have been decimated by COVID-19, the latest 2Q 2021 results have been fantastic in terms of earnings growth from a low base. However, the world is not out of the woods, and with new COVID variants on the rise, it definitely pays to be cautious. In this video, I look to introduce a simple Black Swan ETF that one might wish to consider adding to his or her portfolio. Black Swans are those rare and unexpected events, just like how the COVID-19 pandemic came out of the blue in late 2019. These are the kind of events that have the potential to wipe out all your gains in a single swoop. One might thus wish to look for a way to Black Swan-proof your portfolio. Well, look no further as ETF provider Amplify has provided just that with an ETF aptly named Swan ETF, ticker SWAN. The Swan ETF aims to achieve two objectives. First, to minimize your downside risk as much as possible in the event of a huge market correction. This ETF passed the COVID-19 test with flying colors. When the S&P 500 cratered by as much as 33.5% from peak to trough during the one-month COVID-19 sell-off back in mid-February 2020, the Swan ETF declined by just 8%. The second objective is to replicate the performance of the S&P 500 as much as possible in a bull market. The ETF aims to capture 70% of the upside of the S&P 500 over the economic cycle. For example, over the last 3 months, this ETF generated a return of 6.6% versus the S&P 500 return of 7.8%. It is not as good as just buying the S&P 500 through a ticker such as the SPY, but it is the significant downside protection one would benefit from in the event of these Black Swan scenarios happening again that makes it attractive. And Black Swan events are happening a lot more frequently than what its name makes it out to be. In a nutshell, this ETF seems to be a dream come true for investors looking to mitigate his or her downside risk if a major market correction happens, while yet at the same time able to participate in the upside in a seemingly perpetual bull market like what we are currently experiencing. This is particularly impressive considering that a lot of defensive strategies that work well during a market crash in terms of loss mitigation subsequently faltered comes the market rebound. So how exactly does the Swan ETF works its magic? It consists of two components. First, instead of having stock exposure, the ETF uses call options on stocks. For those who are familiar with call options, you know that it allows you to profit handsomely if the market goes up through that leverage effect. But if the market crashes, your losses are capped. The second component of the ETF is buying US government bonds. Typically, this asset class will benefit during a Black Swan-like stock market crash when investors start piling into these safe haven assets, thus driving their prices higher. So, in a bull market, the call options rise in value while the bonds could perhaps maintain their value. In a bear market, the call option loses its value, which is partially compensated by the rise in the value of the government bonds. However, do note that the two asset classes are not purchased on a 50-50 basis. Amplify allocates around 90% of its capital to the government bonds and only 10% to the call options pegged to the key US index, the S&P 500. 10% might not sound like much, but remember that options are leveraged products. Spending a small amount on the option premium will give you a substantial exposure to the entire market. For those who are interested to find out more about the Swan ETF product, you can check out Amplify's website, which I have put the link in the description segment below. While this product might look like the ideal ETF for an investor looking for strong downside protection and good upside potential, there are a couple of risks that I would like to highlight based on my observation. For example, while it is quite certain that the downside risk is going to be a lot lesser than market during a huge correction, there will no doubt still be losses. The previous COVID-19 drawdown saw this ETF declining by just a quarter of what the general market declined by, but there's no certainty that in the next market drawdown, this ratio can be kept. Second, while the ETF aims to capture 70% of the S&P 500 upside, that again is no guarantee. On a 3-month basis, that ratio is 85%, but on a year-to-date basis, that ratio declined to just 40%. This is because the strategy involves holding a high amount of bonds, which will decline in value when interest rates starts rising faster than expectations. That is what happened in the earlier part of 2021, as can be seen from the chart, which breaks down the performance of the ETF and the S&P 500 on a month-on-month basis. In late February and early March, government bonds saw a sharp sell-off when the 10-year yield rose swiftly to almost hit 1.8% from just 1% at the start of the year. Is this Black Swan ETF going to work its magic again in the next major market correction, which might just be around the corner? Only time will tell. I hope that you have enjoyed today's financial sharing session. If so, do hit the like button and subscribe to the NAOF YouTube channel. With that, this is Royston signing out.